I tried every tip the internet gave me to fix my credit score, and almost all of them were wrong. Is your bank secretly keeping your credit score low? Why do financial advisors never talk about the strategy that can boost your score fast? And what's the one date on your credit card statement that changes everything? In this video, I'm going to show you the 5 ways to fix your credit score fast. Number 1, know how to manage your credit card payment history. So what's the one thing that can destroy your credit score faster than anything else? It all comes down to a simple misunderstanding about how credit card payment history works. Every month, your credit card generates a statement. On that statement, you'll see your minimum payment, statement balance, and your current balance. A lot of people look at those numbers and get confused. Actually, that confusion can cost you serious points on your credit score. The golden rule here is to always pay your full statement balance on time by the payment due date every single month, not the minimum payment, the full statement balance. You may ask me, how does that even matter? It matters because, according to FICO, your payment history is the single biggest factor. It accounts for 35% of your total score. Every time you make your payments on time, it goes up. If you don't, well, you can guess what will happen. It's going to go down and shrink. Surprisingly, it's not even the going down part that scares people. Did you know that a single missed payment can drop your score by 60 to over 100 points and stay on your report for 7 years? But you shouldn't be feeling bad. I bring you good news wrapped in a bucket of Kentucky Fried Chicken. Most lenders don't report a missed payment to the credit bureaus until it's been 30 days past due. So if you realize you forgot to pay, go do it immediately. As long as you can catch it within the 30-day window, you can avoid the report entirely. Now, when it comes to installment loans like car loans, student loans, or mortgages, the same principle applies. You have a fixed payment due each month, pay it on time, and you're good. So how do you keep up? Because as humans, we tend to forget a lot, right? Well, the simplest way to protect your payment is to set up auto pay for at least a minimum on every account. That way, even if life gets busy, you're covered. Now, this is where people lose points even when they think they're doing everything right. Number 2, keep your credit utilization low. Do you know the 30% rule you've always heard is a lie? Let me explain. Most people either ignore or misunderstand their credit utilization. What does credit utilization even mean? It is simply the percentage of your available credit that you're currently using. It affects about 30% of your FICO score. If your credit card has a $5,000 limit and your balance is $2,500, your utilization on that card is 50%. Does this sound like what's happening to you right now? If it does, it means your credit utilization is high, and it will definitely hurt your score. You probably heard keep it below 30%. That's where you've gotten it wrong. It's okay if you have an average score, but if you want to score above 750, you should be targeting below 10%, ideally in the low single digits. What most people don't know is that your utilization is calculated based on your statement balance on the last day of your billing period, not your payment due date. So if you're carrying a high balance right up until your due date and then paying it off, the damage is already done. The Bureau already saw the high balance when your statement closed. How can this particular situation be fixed? It starts with understanding when to pay your balance. You need to pay it down before your statement closing date, not just before your due date. These are 2 different dates. Your closing date is when your billing cycle ends and your statement is generated. Meanwhile, your due date is 21 to 25 days after that. A lot of investors and business owners only know the due date, but your closing date is what really affects your score. Thankfully, all this gets easier because credit utilization doesn't have a long-term memory in most scoring models. If your utilization spikes to 60% in a month because of a big purchase, your score will drop. But the moment that utilization drops back down to a low percentage the following month, your score will recover just as fast. You're not being punished permanently for one high month, so don't panic, but do make it a habit to keep it low consistently. How can this be achieved? You can keep your utilization levels low by requesting a credit limit increase on your existing cards. If your limit goes up but your spending stays the same, your utilization percentage automatically drops. Many card issuers will do this without a hard inquiry if you've been a customer in good standing for 6 to 12 months. A quick phone call or online request could move the needle on your score without changing anything on how you spend. Still, the goal is consistency. Keep your utilization low as often as possible, and your score will reflect it. If this is already making sense, drop a like and smash that subscribe button. And for the complete roadmap, grab my book From Broke to Bankable. Link is in the description. Let's head over to number 3. Number 3, build a good length of credit history. If you only fix one thing after this video, make it your credit history. Closing your old credit cards to clean up your credit is one of the worst things that you can do. Can I shock you? Oh yes, I can. Listen, the length of your credit history accounts for about 15% of your FICO score, and it's made up of two things: the age of your oldest account and your average age of credit, which is the average age of all your open accounts combined. If you don't know before now, your oldest account is an asset. The longer it's been open, the better it looks to lenders. It shows you that you've been managing credit responsibly for a long time. So unless there's a serious reason, don't close your oldest credit card, especially if it has no annual fee. Even if you never use it, keep it open. Put a small reoccurring charge on it, like a streaming subscription, and set it on auto pay. That account will keep aging in your favor for years. For your average age of credit, you need to be careful here. People hurt their credit score by opening too many new accounts at once. Every new account you open drags your average age down. If your oldest account is 8 years old, but you've opened 5 new cards in the last year, your average age might only be 2 or 3 years. That's fine if you plan for it, but it's something to be aware of. The takeaway here is for you to be intentional about when you open new accounts. Don't apply for credit just to get a quick discount at checkout. Every new account has a cost to your average age and your credit score in the short term from the inquiry. Which leads us perfectly into the next way you can increase your credit score. Number 4, space out new credit accounts. Every time you apply for a new credit card or loan and a lender does a hard pull on your credit, your score takes a small hit. It can be between 5 and 10 points. That's not a lot on its own. But if you're applying for multiple accounts in a short period of time, those hard inquiries stack up, and it's a huge red flag. New credit accounts for about 10% of your FICO score, but the real impact here is the signal it sends. Multiple applications in a short window tell lenders you might be desperate for credit, and that raises a red flag. The strategy is just to space out your credit applications. As a general rule, try to wait at least 6 months between applying for new accounts. This gives your score time to recover from each inquiry. Also, it allows your new account to build an average age of credit before you open the next one. My tip here is that before you apply for a new credit card or loan, check if the issuers offer pre-approval. Most major issuers like American Express, Capital One, and Citi do. It only requires a soft pull, so it won't affect your credit score. That way, you can see if you're likely to be approved before you commit to a hard inquiry. Finally, let's talk about the most overlooked factor and the one that can complete your profile. Number 5. Maintain a healthy mix of credit accounts. It's surprising how many people never think about their credit mix. Why would they? It only makes up about 10% of their FICO score. However, it matters more than you think. Credit mix measures the variety of credit you have on your report, specifically a combination of revolving credit, like credit cards or lines of credit, and installment credit, like car loans, student loans, or mortgages. Having both types of credit passes a message to lenders that want to see that you can responsibly manage different types of debt. Someone who only has credit cards looks less experienced than someone who has credit cards and a car loan, for example. Now, I'm not telling you to go take out a loan you don't need just to improve your credit mix. That would be the tail wagging the dog. But if you've been credit card only for years and you're looking to eventually take out a car loan or mortgage, know that doing so responsibly will naturally improve this factor over time. So, this is the strategy I mentioned at the beginning of this video, and almost nobody uses it, but it can build your credit in the background. For people who want to build installment history safely without taking on major debt, there's something called credit builder loans. These are small loans, usually $500 to $1,500, offered by credit unions and online lenders specifically designed to build credit. The catch is that you don't receive the money up front. The lender holds it in a secure account. You make monthly payments, those payments get reported to the bureaus, and at the end of the term, you receive the funds. It works like a built-in savings plan that helps you build credit at the same time. That's it, guys. The 5 things you need to do to increase your credit score fast. Meanwhile, what's your current credit score range and what's your target? Let me know in the comments. If this was useful, hit like and subscribe because we break down money strategies like this every week. And if you don't want to undo everything you've just learned, check out our video on the 7 credit mistakes destroying your financial future. I'll see you there. Wait for more helpful info. Don't forget to check the description below.